Good afternoon, ladies and gentlemen. A warm welcome to our webinar, Income Taxation for G4 Visa Holders, brought to you by IDB Global Federal Credit Union. Our presenter today is the wonderful Dale Mason. With over 25 years of experience in international tax consultancy, he developed his international tax expertise while working as an expatriate tax technical expert in KPMG's Washington National Tax Office. Additionally, while building and directing Central Europe's largest expatriate tax practice for PwC, Dale developed a keen understanding of the issues surrounding living abroad and the significant international tax and financial problems that expatriates face. He earned his BS in economics with an accounting emphasis from the University of California at Santa Barbara. Before we start and Dale shares his expertise, a few reminders. This webinar is being recorded and all registrants and attendees will receive the recording as well as the presentation material via email. If you have questions for Dale, please use the Q&A tool to type your question and he will answer them after the presentation. This is the tool at the bottom of your Zoom screen with the two bubbles. Your feedback is very important to us, so please kindly fill out our survey that we'll be sending via email, and I'll be posting the link in the chat tool at the end of the webinar as well. Thank you, everyone, and enjoy the presentation. Dale, the floor is yours.
Thanks very much, Marilyn. Hello, everybody. It's very glad to know everybody is here. We have a lot of participants today. If I could just ask for the presentation to be put up on the screen, that would be great. I'll just wait a moment for that. There we go. So this is definitely income taxation for G4 visa holders. We won't really be talking too much about US persons, US citizens and green card holders. So if you're a G4 or G4 dependent, then you're at the right seminar. Next slide, please. You know, as Marilyn was saying, I've been working a long time in the international area, and I've been specializing in international organization employees, taxes and financial affairs for about 15 years now. So I look forward to giving this presentation, and then at the end of the presentation, I'll try to answer as many questions as I possibly can, but given the limited time that we have today, it's very unlikely I'm going to be able to get through all the questions. I'll try to answer as many as I can. So you must be asking, why do we start out with a disclaimer? The reason that we start out with a disclaimer is I just want to let everyone know here that the US tax system is the most complicated tax system, bar none, in the entire world. So today, we'll probably be only able to go over the general tax rules, but almost always there are exceptions to the general rules, and then there's exceptions to the exception most of the time. So bottom line here is that you're going to get hopefully a lot out of what I'm going to present today, but please seek professional tax or financial or legal advice based on your own set of facts and circumstances. Today's seminar is not providing you with tax advice or financial advice. This is general overview of tax for G4 visa holders. Next slide, please. So on the agenda today, we have a lot of good stuff. We're going to talk about G4 tax residency and why that actually matters. And we're going to talk a lot about G4 dependent visa holder tax issues, especially since a lot of the G4 dependents work at an organization that's outside of an international organization, and therefore their wages are taxable. And so they have tax filing obligations for 2020. And then we'll talk about the taxation of investment income. You know, I work on a daily basis with a financial advisor, and we find all the time that G4 visa holders don't quite understand the tax rules with regard to investment income. And many times G4 visa holders have set up an inappropriate US tax resident account with financial institutions where they should have a non-resident account. So we'll be talking about that. And then finally, we'll be talking about the taxation of real estate, and in particular, what's called the Foreign Investment in Real Property Tax Act withholding, FIRPTA withholding for short. This has been a very troublesome area for G4s when they sell any type of US property, whether that be their own home or a US rental property. And the reason it's been so troublesome is because of the pandemic has caused the IRS to really delay some of the ways to get back the FERPTA income tax withholding. So you'll definitely want to be staying tuned for that if you're at all going to be selling a property in the near future. Next slide, please. Tax residency. This is one of my favorite subjects, tax residency, and it's really important for everyone here that's a G4 to know about their US income tax residency. Why is that? Next slide, please. The reason is that tax residency makes a big difference under US tax law. Why does tax residency matter? US citizens, green card holders, and persons that have met the substantial presence test of tax residency are considered then tax residents, and you folks are subject to tax on your full worldwide income. If you're a non-resident and 90% or more of the G4s and G4 dependent spouses on this webinar today are most likely non-residents. And it's not that you're exempt from all taxation as a non-resident. You are just subject to tax on certain sources of US source income. So it's US source income that you may be taxable on, such things as a US rental property that you may be renting out to others. That income, because it's in the US, is US source income and subject to US tax. And so that you have a filing requirement for that. We'll be going into that a little bit more in detail later. Next slide, please. So does the tax law say anything about G4 or G4 dependent visa holders? Absolutely nothing. Then why did I say that you're probably a non-resident of the United States? The reason is that the days of presence, the tax code does say is that days of presence in the US are not counted for purposes of the substantial presence test of tax residency if the person, the G4, the primary G4, is a full-time employee of an international organization, the IDB. Therefore, the G4 primary spouse is going to almost always be considered a non-resident of the United States because their full-time employment with the IDB makes them, under the substantial presence test, not count those days that they're in the United States. So it's like you're not even here. And if you're not even here, you're a non-resident of the United States. The tax law also says that people whose visa is dependent on the primary G4's visa is going to be considered also a non-resident. So in G4 dependent visa holders, obviously that includes the spouse, and it also includes unmarried G4 dependent children under the age of 21 years old. They are also considered non-residents of the US. So if your child does some part-time work and earns some money here in the United States, as a non-resident earning money here in the United States, they would be subject to US income tax, and they may have a US tax filing obligation as a G4 dependent visa holder. The same thing, of course, holds true for G4 spouses who work for a non-international organization, maybe a private company here in the US, that would be considered US sources of income taxable to a non-resident spouse. Now, I just wanted to emphasize, but because people get this a little bit confused sometimes, the G4 spouse, your tax residency is dependent on the primary G4's tax residency. So if the primary G4 is working on a full-time basis for the IDB, they are a non-resident, and the G4 spouse will also be considered a non-resident, regardless of whether that spouse is working for a private US organization, or even whether they're working for a foreign company who's paying them for work performed in the US. Because they're a G4 dependent visa holder, their tax residency is based again on the primary G4, and so the G4 spouse is almost always going to be considered a non-resident of the United States, taxable on US source income. Next slide, please. So we have the tax residency of being a green card holder and the substantial presence test of residency, which we basically just talked about a little bit. So generally what happens is people that are an IDB employee throughout their career and then retire from the IDB, they of course have the choice of either leaving the US or staying in the US. And if they decide they want to stay in the US, they of course would apply for a green card. And so the first day of tax residency under the green card test is the first day of US tax residency that they have a valid green card and that they're physically located in the United States with a valid green card. What that means is people that retire from the IDB and are waiting here for the green card, under the green card test of tax residency, you don't become a tax resident when you first apply for the green card. And in these times, I understand it's taking a long time to get a green card. But it's not when you first apply for a green card that you become a tax resident under the green card test. It's actually when you get an approved green card and you're physically located here in the US. That's your first day of tax residency under the green card test. Now we have the substantial presence test, which is coming into effect more and more for international organization employees who retire. The reason that the substantial presence test is starting to apply even more than the green card test is that it's taking a long time to get a green card these days, a really long time in some cases. So what this means is, remember before I was talking about people being full-time employees of an international organization, their days don't count while they're in the United States. However, the first day of retirement that you're no longer employed on a full-time basis with the IDB, that first day starts counting for purposes of the substantial presence test of residency. And so in the first calendar year, if you retire, let's say in April, and you're waiting for your green card and it doesn't come, let's say in the entire calendar year of 2021 and you retired in April, well, if you're remaining in the United States, you'll go over the special 183-day number that the substantial presence test has. And so if you're in the US for more than 183 days in that calendar year, that means that you're subject to you're subject to the tax residency test of the substantial presence test, and you become a tax resident, in my example, in 2021, beginning on the first day of retirement. And in my example, it was April 1st. So people have to take into consideration when they become tax resident, either under the green card test, when they physically get the green card and it's valid, or when they meet the substantial presence test. And what do you think, if they meet both tests in the same year, what do you think the tax law says about when the residency status starts? It's, of course, whenever they can make the most money for the US government, which is the earlier of the green card test or the substantial presence test. That's when you become a US tax resident. Next slide, please. So we talked about the green card test, and of course, if you have a US citizenship, then you're always going to be considered a US tax resident also. But we talked about the green card test, and we talked about US citizenship as being a tax resident and the substantial presence test. But there's another way of becoming a tax resident. But let me just emphasize that this other way of becoming a tax resident only applies to G4s who are married to US people, either green card holders, US citizens, or people who have met the substantial presence test. So a G4 married to another G4, you can't become a tax resident under this what's called the 6013G election. This election allows a G4 to elect to be a US tax resident only if they're married to a US person, and it treats the G4 person as a tax resident for that year and all subsequent years, so they can file a joint resident tax return with the US person on a form 1040, not a form 1040 non-resident, a 1040 NR. So there are some ways to elect to become a US tax resident. But again, this doesn't apply to people who are married, who have a G4, who are married to a G4 dependent visa holder. This election only applies to file a joint tax return for a G4 that is married to a US person. Next slide, please. So what happens, here's some tax residency tips. What happens is a lot of times what I find with international organization employees, they may retire for a short period of time, and then they may come back to the United States to work as a consultant, a part-time consultant. But remember before we talked about the fact that the days of presence in the United States uh, doesn't count as long as you're a full-time employee of an international organization. But those people who may come back as a part-time consultant, obviously that's not full-time, and therefore the days of presence in the United States would start counting for purposes of the substantial presence test of residency. And even though they come back and are working for an international organization, they could become US tax residents if they work on a part-time basis. We already talked about the next bullet in the year of retirement. You may become a US tax resident before you have an approved green card under, of course, the substantial presence test. Next slide, please. So G4 dependent visa holder tax issues. We talked about residency status, and 99% of the time, G4 dependents are going to be non-residents of the US. And of course, if you're a G4 dependent employed by a private organization, not an international organization, then you're taxable on earnings you derive in the US. However, if you're a G4 dependent and you're working both inside the US for a company and they also send you abroad to work, and you come back and forth between the US and the foreign country, remember before we talked about the fact that G4 dependent visa holders are non-residents, and therefore they're only subject to tax on US source income. So if you're working outside the US and inside the US, you'll be able to allocate your wages for work performed outside the US to non-resident days, outside the US days, and therefore you can actually reduce your US taxable income by being able to allocate to the portion of days that you spent earning compensation outside the US, and you're only taxable on compensation you earned in the US. Now, we mentioned before that G4s married to G4 dependent visa holders are almost certainly going to be non-residents of the US. Now, what happens is people who are G4 dependents and have filed the wrong form, for example, I think that TurboTax only provides the ability to perform a 1040 tax return. They don't have the ability to, the software doesn't have the ability to produce a 1040 non-resident tax return. So a lot of G4 dependents, what I find is they look online, they see that the only way they can prepare their own return is using the wrong form, the 1040. They prepare the wrong form, and then when they go to get reauthorization, employment reauthorization, the immigration authorities look at the tax return and they say, wait a minute, this is the wrong tax return. You better hurry up and refile your tax return for the past 3 years, file amended non-resident tax return. You filed the wrong return, you filed a resident tax return, that's incorrect. And so we have this hurry up problem with employment reauthorization. So now you've gone to this webinar, you know not to file a 1040 if you're a G4 dependent visa holder. Next slide, please. So let's go over some of these income tax preparation tips. So we talked just right now about the G4 married to a G4 dependent visa holder. You can't file a resident tax return. And G4 visa holders married to US persons are allowed to file a joint US income tax return, but only if you filed the 6013G election. The 6013G election is not an actual form that you can find online, but if you Google IRS 6013G election, you'll find all the details that you need to know in order to file the proper election. Basically, it's just a piece of paper that you attach to your tax return on the first year that you're filing jointly with a G4 and US person. And you put your name, your address, your social security number, and you both agree by signing this piece of paper that you both agree that the G4 will now be treated as a US tax resident. And that 6013G election is valid for the year you complete the election, and it's unlimited into the future. Unless you decide to revoke it, you get divorced, or unfortunately somebody dies in the relationship, then the G4 is automatically revoked at that point. So sometimes we have a problem with people making the 6013G election. They file a joint return, but of course the G4 working for the IDB, their wages are not considered compensation for purposes of filing a resident tax return. So their wages are not shown on the resident tax return, which of course is good news because they're exempt from reporting, and you don't have to pay tax on those IDB wages if you're a G4 or a green card holder for that matter. But if your wages are not on that 1040 return, then you can't take the dependent or child care credit. This is the child care credit, where you're having your children taken care of by someone else. And the reason you can't take the credit is that both of the jointly filed individuals on the return have to have earned income shown on the return. They have to have some type of wages or compensation or self-employment income shown on the return in order for them to be able to claim the child care credit. So don't do that. And the other thing is that sometimes we have G4 dependents who are filing a return to report their wages, and they try to claim dependents on their non-resident tax return. This is almost always the case that that's not correct. You can't really claim a dependent on a non-resident tax return. And here's kind of a funny thing. You can't claim a dependent unless you're actually a tax resident. You probably need to be physically located in either Canada, Mexico, or South Korea. So if you are filing a 1040 non-resident tax return as a G4 dependent, note that even your US citizen children can't be taken on a US income tax return as a dependent on the 1040 non-resident return, again, unless you somehow are a tax resident of Canada, Mexico, or South Korea. Next slide, please. Okay, taxation of investment income. Now, I think maybe I haven't mentioned it. So I'm a CPA and I help clients with tax returns. And I also work on a daily basis with a colleague of mine whose name is Jose Sobrado. He's a financial advisor, and we both specialize in financial and tax advice to G4 visa holders and other international organization employees. So we're fully able to address any concerns anyone has with regard to how to invest for a G4, as well as how to save for a G4, as well as what are the tax implications of investing for a G4 or G4 dependent visa holder. Next slide, please. So let's get into the taxation of investment income. So most types of taxable investment income are taxed at a flat 30% tax rate and can't be offset by any deductions. If you're taxable on the investment income, it's going to be at a flat 30% tax rate. You need to complete the W-8 BEN form correctly when you're opening up an account at a brokerage firm or a financial institution. So most of the time, you need to make sure that the W-8 BEN provides your US address on as the permanent residence address on the W-8 BEN form. The reason, of course, is that if you're a G4 and you're working a full-time employee of the IDB, you're going to be here for a number of years. Your permanent residence address is probably always going to be your US address. So you want to make sure that that's on the W-8 BEN. But there's many online brokers and other types of brokers that don't understand and don't want to understand anything about G4 visa holders. So many times, you G4s, you have the wrong account set up. You have an account that's set up, for example, if you use, not to pick on Robinhood, but they've been picked on so much lately. If you set up an account with Robinhood, it's very likely that your account is set up as a US account. And because you're a non-resident, it should be set up as a non-resident account, not a US account. This can cause sometimes IRS problems. So you should definitely make sure that the brokerage firm that you're using is going to be able to set your account up as a non-resident account, and the proper withholding is made by the brokerage firm, that 30% tax withholding, if you've set up a proper US brokerage account. Next slide, please. So what is the tax aspects of dividend taxation to a non-resident, to a G-4 visa holder? Well, we talked about before that only US source income is taxable to a non-resident. US source income includes dividends that are paid from US corporations. So if you have a dividend paid by a US corporation, you should be paying 30% tax. And if you have the proper brokerage account set up with a US broker, the 30% tax on dividends from US corporations should automatically be withheld by that brokerage firm. Now, if you don't have the 30% tax withholding performed because you have a US account, you're going to have to self-report that on a US income tax return, again, the 1040 non-resident tax return. If you have dividends that you receive from a foreign company, then that foreign company dividend is not a US source, not US source income, and that foreign dividend is not considered taxable at all to a non-resident. Now, we have many people investing in either mutual funds or ETFs. And if you have a US mutual fund or a US ETF, because they're set up in the United States as primarily corporations, they're not going to be looking through the corporate veil to look at the underlying investments. So if you have a US ETF that, for example, invests in more in foreign stocks than US stocks, any distribution that you receive from that ETF is going to be subject to a 30% tax, even though a lot of the corporations that are actual investments within the ETF are actually located outside of the United States, and you shouldn't be taxable on them. But you are, because you're dealing with a US ETF or a US mutual fund. Next slide, please. So the good news for non-residents is that most types of interest income is completely tax exempt from both reporting, and it's not subject to US income tax. That would include interest income that you receive from the IDB credit union. That's great. Interest income from banks, interest income from US corporations and US government bonds. That's completely tax exempt. However, if you have an account at a brokerage, you have a brokerage account, and that broker, for example, Schwab, I believe, has a Schwab bank and a Schwab brokerage account. If you earn money through the Schwab bank, then that's tax exempt income earned from a bank deposit. But if you earn interest income from the Schwab money market account that's held in the brokerage side of the firm, that's a brokerage account, and that's not tax exempt. And of course, because you're only subject to tax on certain US sources of income, also foreign bond interest is also not taxable to a non-resident. Next slide, please. Okay, so here's something that's very important to understand. We were talking before about non-residents only subject to tax on US sources of income. But the US government defines a US source of income as a non-resident who lives in the United States and works in the United States and lives here for more than 183 days in the calendar year. They can consider capital gains from securities that are located anywhere in the world. They consider that as US source income, subject to a 30% tax. How does this apply in practice? This applies in practice if you have a US brokerage account that holds the securities, or if you have a foreign brokerage account that holds securities. Any capital gains that you recognize, if you're a G4 dependent visa holder, working and living in the United States, and you're here more than 183 days or more in the calendar year, you have to report those capital gains on the 1040 non-resident tax return. Again, those capital gains located in the United States or outside the United States. self-report those on a 1040 non-resident return and subject yourself to a 30% tax. Now, brokerage accounts, even if you have a proper non-resident brokerage account set up in the US, the brokerage firm will not withhold 30% tax on the capital gains. You will have to self-report that. The reason for this is that the whole tax system was set up for non-residents living outside the US, not in the US. So of course, 99.99% of the people live outside the US who are non-resident. And those people who live outside the US and they have capital gains, even from a US brokerage account, if they're not spending more than 182 days in the US in a calendar year, which most likely they're not subject to any capital gains taxation, none. It's only you folks who are living and working in the US and spending a significant amount of time here that are subject to capital gains tax. And the capital gains tax is assessed on the net capital gains. So you can offset any capital losses that you had during the year with capital gains. So for 2020, you look at all your capital gains that you recognized that you sold, and you look at all the losses that you may have incurred that you've sold, and you can net those two, and then you're subject to a 30% tax on the net capital gain. Next slide, please. So what should you do? Set up a proper US non-resident brokerage account. Consider investing in foreign stocks through what are called ADRs. And if you invest in US bonds or fixed income securities, bonds of a US company, corporate bonds, US government bonds, foreign bonds, to reduce your overall taxation. And then at the end of the year, look at your portfolio and try to sell any lost securities that you may have in that portfolio so you can reduce your overall capital gain taxation by, of course, netting the capital losses with the capital gains. Next slide, please. So now let's go into a good subject, the taxation of real estate. Next slide, please. So let's first talk about rental income. Again, if you have a foreign property and you're a non-resident of the US, if you have a foreign property, that's considered foreign source income, not US source income. So you're not taxable, on the foreign rental income. You don't have to report the foreign rental income, it's just not taxable. But if you have a US rental property, it has to be reported on a 1040 non-resident tax return. Now, the interesting thing about rental income in the US, if you are a US person, US citizen, green card holder, people who made the 6013G election to file jointly with a US person, if you're a US person, in order to take tax deductions related to that property, including mortgage interest, property taxes, maintenance, you don't have to make any special election. But if you are a non-resident G4s and you have US rental income, you have to make a special election in order to take any type of tax deductions on your US income tax return related to that rental income that you're receiving. So it's a relatively simple election, and unless you Google it and knew ahead of time that you needed to file this, you wouldn't know whether you needed to file it. And there is a question on the 1040 non-resident tax return about whether you've made the net election. So it's very important that you would have made this net election if you want to take any tax deductions at all related to your rental property. And almost every non-resident that I've ever dealt with and filed tax return, prepared tax returns for, always needs to take and wants to take the net election to be able to take all those deductions related to the rental property. In addition to regular standard expenses that you can take against your rental income and offset it so that you pay lower tax on your rental income, you also are allowed a depreciation deduction. So depreciation deduction, even though your property may be appreciating, you get to take a depreciation deduction, which is based on the building portion of the rental property divided over a 27.5-year life. Yes, 27.5 years they came up with. I have no idea why it's 27.5, why it's not 25 or 30. Maybe it was negotiating the depreciable allowance for a residential real property that's rented out, and you can be a US person or a non-resident renting out this property. It's going to be the same depreciation. You take the building portion, divide it over a 27.5-year life, and you will get a depreciation deduction every year that will offset the income that you have on that rental property. And then you have to be very concerned, and here's something that you should definitely listen up if you are about to sell either your rental property or your principal residence. You're going to want to stay tuned for the FIRPTA withholding, the Foreign Investment and Real Property Tax Act withholding discussion I'm going to have. So whenever a non-resident sells any type of real estate in the US, a US real estate property, whether that be a rental property or a principal residence, you're going to have to pay a withholding tax. A withholding tax will automatically be taken from you by the settlement agent. It'll either be a 10% withholding tax or a 15% withholding tax on the gross sales price of the property that you sell if you're a non-resident. Next slide, please. Before we get into the FIRPTA withholding, I just wanted to make a comment here about the sale of your principal residence. So this only applies, this exclusion, this is a great exclusion, and applies only to the sale of your principal residence, not a rental property. So every individual, resident or non-resident, can exclude up to $250,000 of the gain related to the sale of their principal residence. So for example, if you purchased a principal residence for $500,000 and you sell it for $750,000, that $250,000 gain, as long as you meet the requirements, can be completely excluded from taxation. What are the requirements? The requirements are that the home must be a principal residence. You must have owned and lived in it at least 2 years out of the previous 5 years prior to the sale. So you look at the sales date, you count back exactly 5 years, and if you lived in it and owned it during any portion of those 2 years out of the previous 5 years prior to the sale, you can exclude up to $250,000. And of course, if you are a G4 married to a G4 dependent, then each of you can exclude up to $250,000 each, or up to $500,000 of the gain related to the sale of a principal residence. Next slide, please. So some people think, okay, what I'm going to do is I'm going to move out of my property, I'm going to live in it, then I'm going to move out of my property, and then I'm going to rent it for a while. Well, if you do that, just again, make sure that if you want to take advantage of the exclusion of the gain related to the sale of your principal residence, that you don't rent out your property for more than 3 years, because if you do, you will lose the entire exclusion. Because again, you look at the sales date, count back 5 years, and you must have lived in it at least 2 years out of those previous 5 years. So if you rent your property out or leave it vacant for more than 3 years before the sale, then you lose the exclusion of gain from the sale of the principal residence, which would be a shame. Next slide, please. Okay, FIRPTA withholding, the Foreign Investment and Real Property Tax Act. This was this act, which was implemented, again, was implemented primarily because non-residents, most of them, again, live outside the United States and not in the US. So the US wanted to have the first right of being able to collect some tax from a non-resident who lived outside the US. So if the non-resident living outside the US purchased a property in the US and there was a big gain on the sale, the US would have a very difficult time flying abroad, collecting the money, sending the military to collect the tax on a foreign person that was living outside the US. So they put this rule into play, which is again a tax withholding on the sale by non-residents of any US real property, rental property, or your principal residence. So the US withholding agent, it's actually the buyer or typically they give the responsibility to the settlement agent. The withholding agent is usually the settlement agent, the people that's settling your real estate transaction. They're given the responsibility of performing the withholding. Now, it's going to be either a 10% withholding when the non-resident sells their property in the US, 10% of the gross sales price, or 15% of the gross sales price, depending on the price of the property that's being sold. So if the sales price of the property is over $1 million, the withholding tax rate is 15%. So if you have $1,001, the withholding is going to be $150,000 of income tax withholding. Again, this is just a withholding amount. This is not your final tax liability. In my example I just gave, if you sold the property for $1,001, there would be 15% withholding by the settlement agent, $150,000. But if you purchased the property for, let's say, $800,000 and you sold it for $1 million and it was your primary residence and you shouldn't have to pay any tax on the property because of the exclusion of gain from the sale of the principal residence, then you're going to have the withholding taken away and you're going to want it all back. So we're going to go into a little bit about how to get that withholding back. Yes, so next slide, please. Now, there are some exceptions to the FERPTA withholding. One is if you sell a property for less than $300,000, and of course, in the DC area, it's very unlikely that you're going to sell a real estate property for less than $300,000, but I suppose it's possible. And and this is not working the way it should. In the old days, you could submit a form called an 8288B right when you have the contract for the sale of the property. And if you had a 60-day waiting period before the closing, you could potentially send this form 8288B to the IRS and they would give it back approved, and you could go to the settlement table with an approved, what's called withholding certificate. So the settlement agent would see that the IRS has approved and they could actually give the money back to you right at the settlement table. But that is not happening anymore because of the really lengthy delay the IRS is having because of COVID in the processing of FERPTA withholding paperwork. You see, FERPTA withholding has to all be done by paper. And most of the agents are performing their work from home, but because of the sensitivity of the IRS and the information that's going back and forth, the IRS personnel many times can't even work from home and are only working a very limited amount of time in the IRS offices. So it's causing a very lengthy delay with regard to this FERPTA withholding paperwork. So next slide, please. So this lengthy delay is causing a problem. So let me just talk about, there's two ways to get your withholding back. The first way is through this withholding certificate I just mentioned called an 8288B. Now, because we're here in February, if you have FERPTA withholding taking at the withholding table and you want the money back, you're going to have to do one of two things. You either file the withholding certificate, which is the 8288B. The IRS looks at it, but it takes them now forever and ever to look at the withholding paperwork. The settlement agent, if they receive this 8288B, will keep the withholding at their location, the settlement agent's location, and will not submit it to the IRS. The IRS will look at the 8288B, approve it, send it back to the settlement agent, approved with an approved 8288B, and then the settlement agent is then authorized to give you back your money. But what we've seen lately is this 8288B withholding certificate has taken up to a year to process. So I can't tell you what's going to happen in the near term with regard to this. I assume that when the COVID vaccine gets fully implemented and agents are able to get back into the IRS offices, that this paperwork will go faster. But the only other way to get your withholding back is to file a tax return. And of course, the 2021 tax returns cannot be filed until probably January or February 2022. So if you have FERP to withholding now and you try to get it back through filing a tax return, you're going to have to wait at least 12 months to get your withholding tax back. But I can't tell you that it's going to be anytime sooner if you do the 8288B. So we're kind of in a conundrum at the moment of what to do, what to advise. I probably still would advise, if it's February, to still go ahead and file the 8288B form. If we get to August, September, you might then, and we still see this really lengthy backlog, at that point, you might wait to just to file a tax return in 2022 in order to get your FERP to withholding back. Next slide, please. Here is something extremely important. Now, I'm not a real estate person, but I do understand from many FERP to withholding incidents that the buyer, not the G-4 seller when there's FERP to withholding, but the buyer is the one to select the settlement agent. My recommendation to you folks is, if you're going to sell a U.S. property, make sure that your agent understands FERP to withholding, and make sure that they talk to the buyer's agent so the buyer's agent understands their responsibility for the withholding and what their duties are for the FERP to withholding. It's very important that all parties to the transaction, the settlement agent, the buyer's agent, and the seller's agent, all understand FERP to withholding, because this can be a nightmare if they don't understand it. And especially if the settlement agent doesn't understand FERP to withholding, they can do all sorts of things that will cause a tie-up of this, for you folks, the G-4 is trying to get their FERP to withholding back. So make sure that you have really experienced FERP to withholding agents and settlement agent if you can. Next slide, please. So I have at the top here, there's a typo, free 1/2 financial health checkup. It's not a free one half financial checkup. I mentioned previously that I work with Jose Sobrado, a financial advisor, who we work together on a daily basis. I, of course, am a tax specialist in international organization employees and their families. And Jose is an expert at financial advice for international organization employees and their families. And we work together, coordinating our services. So what we'd like to do is, and thank you so much, by the way, to the IDB Global Federal Credit Union. I just want to thank them so much for sponsoring this event, but I just wanted to let everybody here know that Jose and I are giving a free 1/2 hour financial health checkup to the first 10 IDB Global Federal Credit Union members who send an email to dale@dalemasoncpa.com. In the subject heading, just put checkup. So again, if you would just send an email to dale@dalemasoncpa.com, that's DALE@DALEMASONCPA.com, and just put checkup in the subject line, and the first 10 of you who sign up will get a free financial health checkup from Jose and I. Now, I can't promise, because it's busy season. It may be that it's going to be at the end of March, or it might actually even be after April 15th that you're able to utilize the free financial health checkup. But go ahead and write to me, and be glad to give you that checkup. Next slide, please. And just so everyone understands, so I'm primarily a international tax consultant, and again, I specialize in the international organization employees taxes. So if you need tax return preparation assistance, if you need, of course, financial assistance, if you want to know how to invest, contact me and we can work together with Jose Sobrado. So anything financial and tax related, go ahead and contact me. Here again, my email address and my website address. So now what we'll do is we'll go into Q&A. And I see here I have an enormous amount of Q&A. So again, I will get through as many possible Q&A questions that I can in the limited time that we have available. But let's see, here we go. Some of them may be too personal and too specific for me to answer, so I may broaden the question. So what is the tax rate for money earned in equities or ETFs? If there is a range according to what one earns, could you tell us what that range is? So a person who is a non-resident pays tax at a flat 30% tax rate on investment income. And that would include, of course, dividends from US companies and capital gains. Excuse me, it's a flat tax rate and it is not progressive. So it doesn't matter how much you earn, you'll always be subject to a flat 30% tax rate on investment earnings. Let's see. Can you use mortgage interest to offset capital gains for tax purposes? So if you're a non-resident married to a other non-resident, there's a very limited amount of itemized deductions that you can take on your non-resident tax return. Primarily, that's state income tax and charitable contributions made to US charities. However, those types of itemized deductions will only offset a G-4 spouse's earned income from compensation earned from a private employer. It will not offset any type of investment earnings that are always subject to tax at a flat 30% with no deductions available. So if you have a capital gain of $10,000, you're going to have to pay $3,000 of capital gains tax to the US government using the 1040 non-resident tax return. And even if you have a large amount of US charitable contributions or large amount of state income tax that you have to pay, you can't offset that $30,000 of tax. There's just no deductions available to you as a non-resident. Okay, let's see what else we have here. Can G4s open 529 plans? This is a very good question, and I'm going to caveat this a lot. So the problem that we see in practice is that, and we've had G4s contact their 529 plan state administrator, and it doesn't seem like anybody can ever come out with the correct or with a good answer or any type of answer if they contact the 529 plan. 529 plans typically say that non-residents are not eligible, but we don't really understand what non-resident in that context means. It doesn't say non-resident alien for tax purposes. So Jose Sobrado and I are very hesitant to advise people that are G4 and G4 dependent non-residents to invest in 529 plans, because we're not sure whether the 529 plan itself is supposed to be or will be or is open to non-residents. The issue seems to come into play when if you just try to open up an account at a 529 plan, it doesn't really ask you whether you're a non-resident. If you have a US address and a US Social Security number, many times you're just able to open up an account, but it doesn't ask you whether or not you're a non-resident. So we caveat it and say we don't really know what the right answer is to this, but we're a little bit concerned because of this limitation that usually 529 plans have with regard to investments by non-residents. We typically advise if there's any other way to invest, and there is, in a tax efficient manner, you should probably stay away from 529 plans as a non-resident. Let's see. Thank you for the presentation. My husband is a G4 visa holder, and last year, due to the pandemic, he ended up spending 241 days in the US. The only income he received from his job back at the University of Uruguay, my understanding is that the substantial presence test does not apply due to being G4 and only needs to pay taxes in Uruguay. Okay, so if your spouse is a G4 dependent and you're a full-time employee of the IDB or any other international organization, your spouse is going to take that non-resident status on, and it doesn't matter how many days he or she spends in the United States, they're still going to be a non-resident of the US. And as long as all the work that was performed in this particular question, as long as all the work was performed for the University of Uruguay outside of the US and not in the US, then your spouse should not be subject to any US tax on the work he performed for the University of Uruguay. By the way, if he did perform work just by sitting at a desk in the United States for the University of Uruguay, and he's compensated, and it doesn't matter that the compensation went from Uruguay to an Uruguayan account that your husband may have in Uruguay, it's still taxable by the US government for the mere fact that he was earning his compensation on US territory. So if you earn any compensation on US territory, no matter who the employer is and what bank accounts they use and pay it into, the person is still subject to tax as a non-resident in the United States if they perform any physical work physically located in the US. Of course, this only doesn't apply to the G4s who are working for the IDB. All that compensation is tax exempt. Let's see what else we have here. Yes, again, if you have a spouse working as a G4 dependent for a private US company, and he or she works in the US for any time period, then he or she has a US tax filing requirement. Let's see. What happens if your non-resident return, still hasn't been processed all the way back from 2019? Here's another paperwork issue we have with the IRS because of the pandemic. So if you file your tax return as a non-resident and you're requesting any type of refund as a non-resident, the IRS actually physically checks out that paperwork and actually has to look at the withholding tax that was withheld by you, typically an employer, or it may be on a 1042-S form. That's a form that you get as a non-resident that you earn investment income. And if that investment income has been withheld upon, if you are claiming any type of refund on a non-resident return, the IRS actually has to physically look at that return, look at the withholding that was taken by the employer or the brokerage firm, and trace it to make sure that the IRS received in its accounts the actual withholding funds from the financial institution that withheld the dividends, for example, or the employer that withheld the tax from payroll. So that's why it's taking a long, long time. So don't be surprised. And as a matter of fact, the IRS website right now says, don't even follow up with the IRS on where's your refund as a non-resident unless you've let at least 6 months go by. Okay, what else can married G4 file a joint tax return? I think we covered that. No, you can't if you're a G4 married to a G4 dependent. Just to clarify, as a spouse of a primary G4 visa holder, will have to pay taxes on money earned from a job in the US. Yes, we covered that. I'm just kind of going down here. Well, here's one that might be interesting for people. I'm a G4 visa holder with a 401k. My contributions are Roth. Will I need to pay any taxes when I get money at retirement? Does the answer change if I become a permanent resident? What if I get my money before I'm 59 and a half years old? Well, let's just talk about 401ks and Roth 401ks in general. So a 401k, this person is obviously a G4 dependent working outside of the IDB for a private company that offers a 401k. And they offer what's called a Roth 401k. What that means is this person, this G4 dependent, will be paying tax on their full amount of the income that they earn at their company. And there will get no deductions available to them for making traditional 401k contributions. Instead, they're making before tax contributions to a Roth 401k, which means that on a Roth 401k, you don't get any deductions up front like you do a traditional 401k that reduces your taxable income, but instead, you on your gross payroll, you're contributing your gross payroll before tax to the Roth, and then the buildup, you will obviously over your career and over the time as it elapses, you'll have investment income within that Roth 401k. The good thing about a Roth 401k is when you retire, I should say after age 59 and a half, you can withdraw the money after 59 and a half as long as you've had the 401k in existence 5 years, and there will be no tax either on the investments that you made or on the earnings that you derived. Now, what you have to watch out for as a G4 that has a Roth 401k is that if you retire or if your spouse retires from the IDB and you retire from your company and you decide that you want to leave the US and go back to your home country, and then you withdraw the money from the Roth 401k, that's okay for US tax purposes. You'll never be subject to tax, again, as long as you're over 59 and a half, and as long as you've held the account for more than 5 years. When you withdraw the money, the US definitely will not be taxing you at all on that Roth 401k distribution. But if you are in a country that doesn't recognize US tax law, you may be subject to tax in that foreign country. So you always have to do planning before you leave the US and just leave the US after retirement and go to the foreign country with regard to Roth 401ks or even traditional 401ks or any type of US pension accounts. Okay, let's see what else we have here. Yes, we talked about interest income being tax exempt from US Treasury bonds. Yes, people have told us here in the questions that people are having trouble getting a Roth, getting a proper US non-resident account because they've used Robinhood. I think it's almost impossible, and you need to change brokers if you can't get a proper non-resident account. We'll go down for a few more here. Okay. If we have realized capital gains, but we're not in the US for more than 183 days, does it mean that we do not report those capital gains on our 1040 non-resident tax return? Yes, it does mean that. So again, in order for you to have to pay capital gains tax to the US, it means that you would be working and living in the US and you spend 183 days or more in the US during that calendar year. So if you haven't spent 183 days or more during the calendar year in the US, and then you sell your securities, then you wouldn't have to pay any capital gains tax to the US. Let's see what else we have here. Okay, so the US, it only assesses tax based on the actual transaction that you have, not where the cash flows. So if you become a US person, for example, a green card holder or US citizen, and you have a transaction, let's say you sold a piece of property in Colombia. You sold the piece of property in Colombia at a large gain. Let's say the gain was $100,000. Because you're a US person and you sold a foreign property, remember your worldwide income would then be subject to US tax, and including that sale of land in my example in Colombia. So you'd have to report that gain on your US tax return, and it doesn't matter whether you brought the cash into the United States or not. All that matters is the transaction in that case. So it's the same for non-residents. If you have a piece of property, a real estate property located in Colombia or elsewhere outside of the United States, and you sell that property at a gain, because you're a non-resident and because that's foreign source income, not US source income, then you're not taxable on it. And it doesn't matter whether you keep the money in Colombia or any foreign country, or it doesn't matter whether you bring it into the United States, it still would not be taxable to you because, again, that's foreign source income and you're a non-resident. Again, the cash doesn't matter where it's going and where it's coming from. Let's see here. Okay. We have a lot of 183-day questions. I'm going to since we have 75 questions, I'm going to try to pick and choose ones that may be applicable to everyone here in the next couple of minutes. Yes, Robinhood is problematic. So if you don't have a proper U.S. If you don't have a property U.S. non-resident account and you received dividends from a broker that just is recognizing you as a U.S. person, there would be no withholding, and so you have to self-report that on a 1040 non-resident tax return. Okay. Okay, so I think what we'll do is we'll answer just a couple more questions here. Hello, what happens to those that are in the process of changing status to green card through marriage? How will be the best way to file jointly to get a tax return? Okay, so this is a little bit, you may need to seek some consultation regarding this. So if you are in the process, let's say that you're a G-4 visa holder, but your spouse is a green card holder or a US citizen, it is possible, as I was saying before, to file a joint return and to become a US tax resident through this election called a 6013G election. Regardless, even though you applied for a green card, even though you don't have it yet, as long as you're married to a US person, you can file a joint income tax return. Now, whether or not that makes sense from a financial and tax perspective is another matter. We can't go into that now, but what's important to note is that if you become either through once you get your green card, or if you file this special election to file jointly, you become a US tax resident, and then your full worldwide income is subject to US tax, but not, of course, your IDB wages. And that would be the case. Green card holders are not subject to tax as a G-4 visa holder on their compensation, and they're not subject to tax as a green card holder on their compensation. So just realize that once you get your green card, you still won't be taxable on your compensation, but any other types of income you have around the world will be subject to US tax. Okay. So the last question I think, Marilyn, we're going to take is this. What are examples of deductions to rental income from property owned and rented by a G-4, and how do I get graduated rates compared to the 30%? Perfect question. Thank you very much for that. As we talked about before, if you're subject to tax on your investment income, then you're taxable at a flat 30% tax rate. The reason for this net election that I spoke about previously was that if you don't make the net election, you are subject to tax on your rental property on the gross income or the gross rents that you receive on your rental property. So if you receive gross rents during the year of $10,000, you'd have to pay $3,000 of tax if you don't make the net election. This election, again, is just filed in your first year that you have a rental property. It's attached to the return. It's not a form. You make a special net election. You can Google online how to make the net election, and that will allow you to take any and all deductions related to that rental property. Now, the good thing about taking deductions related to the rental property is some of these deductions you can't get on a 1040 non-resident tax return regarding your principal residence, but you can get them if you're renting the property. So for example, property taxes and mortgage interest related to your principal home, your principal residence, are not deductible on the 1040 non-resident tax return. But if you have a rental property and you make the net election, you can deduct mortgage interest related to that rental, property taxes related to the rental, maintenance, repairs, you name it. Anything that helps generate that rental income is deductible for US purposes, including a depreciation deduction, as we talked about before, you can depreciate the building portion, not the land, over a 27.5-year period. So with that, thank you very much, the credit union, and for everybody for listening. And I'm surprised always at how many people stay with us, even though we're talking about tax. I think there might be a beautiful cold day outside here in the DC area. But I'll now just turn it over to Marilyn. Thank you very much, Marilyn.
Wonderful information, Dale. Thank you so much for sharing that with us, for explaining it so eloquently and well, because I know there's a lot of complications. And also thank you to our audience for being with us here today. Your opinion is actually very, very important to us. So I did put a link in the chat. So if you can please take a survey, post this webinar, and let us know your opinion about the webinar, what else you want to see regarding the webinars that we're hosting this year. So you will also get an email after the presentation that you can fill out that contains the survey link. Don't forget, we're hosting 12 webinars this year and probably more to come. So go to our site, idbglobalfcu.org, under webinars and events, and you'll see the list there today. I would like to thank everybody for joining us. Thank you for the crew for helping us host this at IDB. Thank you, Dale, again, for being such a wonderful presenter. I hope everyone has a wonderful and great rest of your day. Thank you, everybody.